So what actually gives something value? I mean, really think about it. Today, we're going to dive into that question by looking at three totally different worlds. You've got traditional stocks, the wild west of cryptocurrency, and, the timeless world of fine art. How can a piece of a company, a string of code, and a splash of paint on a canvas all be worth millions? Well, let's get into it. I mean, you'd think they have absolutely nothing in common, right? One's a slice of a corporation, another is just a digital token, and the third is a physical thing you can hang on a wall. But here's the crazy part. Billions, and I mean billions of dollars are poured into all of them. So what's the connection? Is there some kind of secret logic to how we figure out what they're worth? That's the big puzzle we're going to try and piece together today. All right, first up, let's start somewhere familiar, the stock market. For decades, this has kind of been the gold standard for investing, It's got a pretty clear rule book for how we think about and categorize value. So this is going to be our baseline, our starting point for everything else. Basically, the stock world is all about neat little boxes. You can sort them by size, you've got your huge, stable, blue-chip companies, and then you've got the smaller, riskier ones with more room to grow. Or you can look at what they do with their money. Do they plow it back into the company to get bigger, or do they pay it out to you as income? See? It's a system built on real, tangible stuff like profits and business plans. Keep that in mind, because things are about to get a whole lot weirder.
Okay, so now let's jump into our first big paradox, Bitcoin. I mean, think about it. This is an asset with no earnings report, no CEO, not even a physical office. It just completely shatters all those traditional rules of valuation we just talked about.
So if none of the usual rules apply, then what does? What is really driving the price of Bitcoin up and down? It's a question that's had economists and investors scratching their heads pretty much since day one. Well, the common wisdom, which you hear a lot, is that Bitcoin is kind of like a digital commodity. Think digital gold or oil. The idea is that the more computer power, or hash rate as it's called, that's being used to mine it, the more valuable it has to be. A classic supply and demand thing based on how much it costs to produce. Sounds logical, right? Well, maybe not so much. And this is where the plot thickens. A 2018 study came out, and it reached a pretty shocking conclusion, that hash rate, the very thing everyone thought was the key, is, irrelevant to Bitcoin's price. Let me say that again. The cost to create a Bitcoin doesn't seem to have any real impact on its value. At all. So why? What's going on here? Well, it's pretty simple, actually. Unlike gold, or if you get more miners, you can literally dig more gold out of the earth, Bitcoin doesn't work that way. Throwing more computing power at the network doesn't create more Bitcoin. The supply of new coins is hardwired right into the code. It's on a fixed schedule. So more miners just means you have more people fighting over the exact same fixed slice of the pie. So if the usual fundamentals are out the window, what's left? Well, one idea that gets thrown around a lot is something called the greater fool theory. It's pretty much what it sounds like. It's the idea that you buy an asset not because it has any real value, but because you're betting that some greater fool will come along and buy it from you for an even higher price. In this world, value is all about collective belief and pure speculation. All right, let's switch gears completely. We're going from the purely digital to the very, very physical. Let's talk about fine art. It feels like a totally different universe, but you'll see it shares a very similar mystery when it comes to value. The question of what makes it valuable is just as tricky. Get this, 12%. What if I told you that was the average annual return on fine art for 50 years, from 1960 to 2010? Yeah, and according to the research, that was actually higher than the stock market during that same period. Kind of blows your mind, right? But that number is not the whole story. Not even close. Because here's the catch, and it's a big one. While those returns look amazing on paper, the risk was just off the charts. The research showed that art prices are incredibly unpredictable. A painting could be worth double one year and then lose half its value the next. The price swings were just absolutely wild. So, the bottom line from all this research is pretty clear. If you're looking at it just as a financial investment, fine art is a really tough sell. That huge, massive risk just wipes out the appeal of the high returns for most people. And that tells us something really important. Its value has to be coming from somewhere else, something that you can't just plug into a spreadsheet. Okay, so where does that leave us? We've got three completely different assets, and they all seem to have these bizarre, puzzling ways of being valued. But what if there was a single concept that could help us make sense of all of them? A kind of unifying theory. Let's talk about something called the competitive moat. The idea of a competitive moat is actually really simple, but it's super powerful. Just picture a medieval castle. What protects it from invaders? The moat, right? That big ditch of water? Well, in the world of investing, a moat is basically the same thing. It's a special advantage that protects an asset's value from being attacked or worn down by competitors.
And what's so cool is how this one idea ties everything together. For a stock, the moat is something you can often touch and see, like patents, a super famous brand name, or a massive factory. For Bitcoin, the moat is its network. The more people who use it, and crucially trust it, the stronger and more valuable that network becomes. And for a piece of art, its moat is built on extreme scarcity and the power of its story, the artist's reputation, their legacy, and what that piece means to our culture.
So maybe, just maybe, value isn't about some single magic formula. Maybe it's really about understanding the unique moat that protects each and every asset. And that brings us to one last really important question. We've seen today that value can come from a solid business plan, a sprawling digital network, or just a really powerful story. But as technology keeps churning out new kinds of assets, things we can't even imagine right now, how is our own definition of value going to be forced to change with it? The real challenge isn't just figuring out today's assets, but being ready to adapt our thinking for tomorrow's. Thanks for watching.